It's 7:55 a.m. GMT. You've got your coffee, your screens are glowing, and the London Open is exactly 5 minutes away. You are staring down the most crucial window of the trading day. This chart shows exactly why 8 a.m. is the golden hour of global currency trading. That spike happens because nearly 38% of all daily turnover hits the market the moment London wakes up. This is the window where the majority of institutional orders are processed. By identifying the direction of this initial flow, you aren't just guessing, you're following the momentum of the smart money as it sets the daily trend. Trading outside this window is essentially trying to surf in a bathtub. To actually capture meaningful market movement, you need the heavy waves of liquidity that this specific time frame provides. But the instant the clock strikes 8, that liquidity creates an absolute explosion of volatility. The charts fracture. You immediately face a choice. You can anchor yourself to safe, highly liquid pairs, or you can chase the aggressive, high-speed price swings. You won't find a universally perfect chart. Morning trading requires a strict, deliberate trade-off between mathematical predictability and extreme, raw volatility. The baseline economic rule of the London session is simple. When global liquidity peaks, broker spreads shrink to their absolute minimum. This matrix tracks the behavior of the Euro-USD, often called the fiber. Its defining characteristic in the morning is technical obedience. It respects support and resistance levels with sharp precision. Because it is the most heavily traded pair on the planet, the financial cost to enter a Euro-USD trade at 8 a.m. often drops to tiny fractions of a single pip. But that safety requires a trade-off. You have to accept slower, heavily structured price action. You are playing for highly reliable but ultimately smaller daily pip targets. On the opposite end sits GBP-JPY, known on the floors as the Beast. The morning session forces a massive tug-of-war between the Japanese yen's Eastern safe haven status and the British pound's Western risk-on momentum, creating massive 80 to 100 pip swings. The dark side of that volatility is the frequency of stop runs. Institutional algorithms will intentionally spike the price directly through obvious resistance levels to trigger retail stop losses before reversing. You will watch the price violently whip around, wiping out underprepared retail accounts in seconds before snapping into the actual daily trend. Deciding between the fiber and the beast is a direct measure of your emotional discipline and your capital limits. You have to trade the pair that matches your specific threshold for pain. To survive those algorithm-driven fakeouts at 8 a.m., professionals rely on a rigid mechanical system called the Asian range breakout. This chart illustrates the first defensive step. You isolate the flat price action by drawing a strict boundary around the exact highs and lows established between midnight and 7 a.m. GMT. Now you wait. You hold your execution and let the initial 8 a.m. volatility thrash around inside that box until a clear 15-minute candle forms. The exact trigger for entry happens only when a candle closes completely outside of your established Asian range. That is your confirm signal to execute.
Your defensive parameter is non-negotiable. You place your stop loss exactly at the mathematical midpoint of the box you drew. Offensively, you calculate a strict 1-to-2 risk-to-reward ratio based on the total pip width of that initial boundary. The hardest part of this strategy is psychological. You have to sit on your hands and watch aggressive early price action happen without you. You sacrifice getting the absolute bottom entry price. In exchange, you get mathematical confirmation that the institutional momentum is actually behind your trade. Intermediate traders rarely fail because their strategy is broken. They fail because they try to use the exact same lot size across pairs with wildly different volatility profiles. Let's look at the raw math. If you trade one standard lot on Euro-USD, every pip the market moves is worth roughly $10. On a highly volatile morning, a sudden 50-pip whipsaw means you are down $500 in minutes. On a standard $10,000 retail account, that is a massive 5% loss in a single swing. Systematic traders survive by anchoring their exposure. They strictly limit their total risk to a maximum of 1-2% of their account balance per trade. This scale visualizes the necessary adjustment. When you trade GBP-JPY, you have to widen your stop loss to survive the chaos. To keep your exact dollar risk perfectly level, Your traded lot size must dynamically shrink. The operational rule is absolute. If a volatile pair requires a 50 pip stop instead of your usual 25, you slash your lot size in half before you click execute. Your long-term survival is determined entirely by how you adjust your leverage before entering the market, not how you react to the chart afterward. To pull this together, we use a final decision matrix to match your specific constraints with the correct asset. If you are a systematizer looking for consistent base hits, your path points directly to UR/USD and the Asian Range Breakout Strategy. If you're a volatility seeker stomaching massive intraday swings, your path routes to GBP/JPY, but you must have your lot sizes to absorb stop runs. Of course, geography dictates strategy. If you are a US-based trader, holding a 3 a.m. wake-up call for the London Open is rarely sustainable. Your alternative is the power hour. You target 1300 GMT, the exact window when London and New York are both actively trading, and focus on pairs like USD-CAD. Overlap traders must follow one strict rule: never execute during the first 5 minutes of major US data releases. Slippage will devastate your entry price. Before you fund an account, open your charts today. Manually trace the Asian range box on GBP/USD for the last 5 trading days. Wait to see how many times a 15-minute candle successfully closed outside the boundary, and calculate your exact strike rate. Prove the math works before risking live capital. While these strategies target large moves, capturing them effectively requires institutional-grade spreads. Over 100 trades, the difference between a high markup spread and a 0-pip raw spread often separates a profitable year from a losing one. The morning market is highly generous to those who align their risk profile with a rigid system. It is entirely ruthless to those who guess.